In early 19th century America, money was not something you could fully trust. There was no single national currency that everyone recognized. Instead, the country ran on a patchwork of coins, paper notes, promises, and reputation. What counted as money in one town could be useless just a few miles away. For ordinary people, this created constant uncertainty. You could be paid in banknotes that looked official, felt real, and carried authority, only to discover later they were nearly worthless. Money depended not on law, but on belief, and belief was fragile. This wasn't chaos caused by war or disaster, it was daily life. People learned to live cautiously, to question every note, and to treat money as something temporary rather than permanent. With no central authority controlling currency, private banks stepped in. Thousands of banks across the country began printing their own paper money. Each note promised value, backed not by a unified system, but by the bank's reputation alone. If you trusted the bank, you trusted the money. If you didn't, that paper was worthless, and trust wasn't evenly distributed. A note from a well-known city bank might be accepted at full value, while one from a small rural bank could be discounted or outright refused just a few miles from where it was printed. Banks quickly realized how powerful this was. Printing money let them expand credit, hand out loans, attract deposits, and grow fast, very fast. But there was a catch. The temptation to print more was constant, and restraint rare. Competition made it worse. When one bank printed more notes, others followed just to keep up. Money flooded the system, untethered from real reserves. On the surface, everything looked fine. Business was booming, credit was easy, optimism was everywhere. But underneath, trust was slowly turning into overconfidence. And overconfidence, as history loves to remind us, is usually the calm right before the crash. In this system, money lost value as it traveled. A banknote issued in New York might be worth full value in the city, but only 80 cents in a nearby town. Farther away, it could drop to 50 cents or less. People carried price guides listing which banknotes were trusted and which were not. Everyday transactions required mental math, suspicion, and constant negotiation. Commerce slowed. Confusion ruled. Distance became a financial tax. The farther you moved, the poorer your money became, even if the paper looked the same. Markets became fragmented, local, and fragile. A single failed bank could ripple through entire regions overnight. Trust didn't travel well, and neither did growth. What should have been a national economy felt more like dozens of disconnected systems stitched together by fragile paper promises. Where confusion exists, opportunity follows. Fraud exploded. Some banks were created solely to print money and disappear, known later as wildcat banks. They issued notes far beyond their actual reserves. Counterfeiters thrived. Fake notes flooded markets. Even experts struggled to tell real from fake. Ordinary people had no chance. Entire guidebooks were published just to identify fake money, a sign that the system itself had failed basic trust. Scammers exploited the chaos relentlessly. Fake banks, fake notes, fake promises stacked on top of each other. Every transaction carried the risk of loss. Money, meant to be a stable foundation of trade, had turned into a guessing game where the house usually won. When financial panics hit, like 1837 or 1773, this system collapsed instantly. Banks stopped honoring their notes. Money became paper overnight. Savings vanished without warning. Because there was no central backstop, fear spread faster than facts. People rushed to exchange notes only to find doors closed. The more panic grew, the more money lost value, creating a feedback loop of collapse. Confidence didn't just disappear, it reversed. Trust turned into suspicion almost overnight. Businesses failed in chains. Wages went unpaid. Trade froze as people hoarded whatever hard money they could find. What began as financial stress quickly became a social crisis, exposing how fragile an economy becomes when its money depends entirely on belief. Large banks with political connections survived. Small banks didn't. Wealth concentrated slowly but steadily. Businesses with access to reliable credit outlasted those without it. For the wealthy, uncertainty was manageable. For everyone else, it was ruinous. The system rewarded scale and punished vulnerability. Survival became less about fairness and more about position. Those closest to power stayed liquid. Everyone else sank. In both the US and Europe, the pattern repeated. Financial crises didn't level the playing field, they tilted it. Each collapse cleared out smaller players while strengthening those already entrenched. What emerged wasn't stability, but hierarchy. Banking systems grew safer for insiders and far more dangerous for everyone else. Ordinary people learned a harsh truth. In a world without safeguards, access to power was worth more than gold. Americans feared centralized power. A national bank felt dangerous. Private money felt local, flexible, free. Even as the system failed repeatedly, resistance to reform remained strong. Freedom was valued more than stability, until instability became unbearable. Many believed chaos was the price of liberty, even when that chaos kept destroying livelihoods. Banks collapsed, notes became worthless, and entire communities were thrown into sudden poverty. Yet the idea of giving power to a single authority remained deeply controversial. The debate wasn't just about money, it was about trust, independence, and who got to decide the rules of the economy. Mechanics had exhausted public trust. Then came the Civil War, and with it, a financial emergency unlike anything the United States had faced before. War demanded scale. Soldiers needed to be paid. Supplies had to move fast. The old patchwork of private banknotes simply couldn't support a national crisis. In 1862, the federal government issued paper money of its own, the first widely used national currency not tied to a single private bank. Soon after, the National Banking Acts of 1863 and 1864 reshaped the system entirely. Private banknotes were taxed out of existence. Standardized federal money replaced them. By the end of the war, the era of private money was effectively over. After the Civil War, America entered a new financial age. The lessons from decades of private money chaos were impossible to ignore. Uniform currency restored trust, but it also introduced something new: dependence on federal oversight. Banks no longer controlled money creation alone. The government set rules. National banks expanded. Credit became more predictable. For the first time, money held the same value whether you were in New York, Ohio, or Illinois. But stability came with trade-offs. Power centralized. Small local banks lost influence. Financial control slowly shifted toward national institutions and urban centers. The system was safer, but less flexible. By the late 19th century, America had traded monetary freedom for financial order, and most people accepted the deal. America once treated money as an opinion. It paid the price. The experiment proved one thing clearly: when everyone prints money, no one truly controls it, and when no one controls it, everyone pays. Prices soared, trust eroded, and ordinary citizens bore the consequences of decisions they could not influence. The chaos revealed a harsh truth: systems that appear orderly can collapse if their foundations are built on unchecked authority or collective assumptions. This era remains a warning, not just about money, but about what happens when systems rely too heavily on trust without protection. It reminds us that stability requires rules, oversight, and accountability, and that without them, even the most essential institutions can become fragile, vulnerable, and ultimately dangerous. History whispers that lessons unlearned are risks repeated, and the price of negligence is rarely paid by the powerful.